This video will help you understand how ordinary income tax rates and capital gains tax rates work in tandem. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. A very common question I get all the time is whether or not one's capital gains will affect how much they pay on ordinary income taxes. And the short answer is no. Long-term capital gains do not affect ordinary income tax rates, but the opposite is true. The ordinary income one generates does affect how much they pay on taxes for their long-term capital gains. And so in today's video, we'll break down how these two different tax schemes interplay so you can ultimately use it to affect yourself in paying as little in tax as possible, or at least knowing why you're paying as much as you are. So let's jump in. So you might already know this, but when you file your tax return, all of your income sources get jumbled up together and generate a number called your adjusted gross income. Colloquially, we can divide the adjusted gross income into two main tax types. You've got ordinary income and you've got capital gains. For the purposes of today's video, when I say capital gains, I'm going to be solely referring to long-term capital gains because short-term capital gains are taxed the same as your ordinary income. And long-term capital gains is simply defined as anything you've owned for longer than a year. Ordinary income are things like salaries, bonuses, self-employment income, pension income, social security income, etc. Capital gains, on the other hand, that is any sort of gain you generated from the sale of a capital asset, namely things like stocks or index funds or cryptocurrency or real estate. Ordinary income on the federal level is taxed somewhere between 10 and 37%. You might end up paying more on things like net investment income tax. We're going to leave that outside the scope of today's video. And of course, your state might levy a state income tax as well. Again, beyond the scope of today. Capital gains, specifically long-term capital gains on the other hand, is taxed in the ballpark of 0 to 20%. So all else being equal, you'd much rather pay taxes on $1 of long-term capital gains than $1 of ordinary income. Generally, throughout your accumulation years, you don't have a tremendous amount of flexibility for which income source you can derive most of your income from. However, when you're retired and you actually are in control of various spigots of income you can turn on or turn off depending on which accounts you want to liquidate money out of, that puts you more in the driver's seat to dictate which sources of income you're generating more of and ultimately dictates how much you pay in taxes. This strategy of pulling certain money out of certain tax types accounts is called tax bracket management. Again, that's beyond the scope of today's video, but if ever you want to Google a term, that's what it's called. Let's say Bob and Sue need $100,000 of income to pay all their bills throughout retirement, and we'll say half of that income comes from Social Security. Well, they're going to have to find the other half through their various other assets. Maybe they're selling some stock in a taxable brokerage account and paying some capital gains. Or they're pulling money out of a pre-tax retirement account like an IRA, and that's fully ordinary income taxable. Or, of course, they're pulling money out of a Roth account, which of course is tax-free. So based on their projections, it might make sense to prioritize certain buckets over another, and maybe a combination of all three buckets to keep them in the lowest possible effective tax rate throughout their retirement years. Again, that's called tax bracket management. It's beyond the scope of today's video. Now, as mentioned before, once you source all of your various income together, you generate a number called your adjusted gross income. From your adjusted gross income, you then subtract either the standard deduction or an itemized deductions total, whichever is a higher number. Then you get total taxable income. Now, this might seem like a nuanced point, but ordinary income is taxed first, and then capital gains are added on top. So just memorize that mantra. Ordinary income is taxed first, capital gains are added on top. So when it comes to taking the standard deduction from both parts of this equation, you take the standard deduction from your ordinary income first, then capital gains are added on top. So in this regard, can generated capital gains add to your total ordinary income for the purposes of ordinary income taxation? No. Ordinary income is taxed first, capital gains is added on top. The alternative is true though. Ordinary income is taxed first, so if you generate a ton of ordinary income and then capital gains are added on top, then your ordinary income generation can affect how much you pay in long-term capital gains taxes. So for a visual of what's going on here, I'm going to pull up a quick Excel spreadsheet I put together that sort of breaks down how these brackets play with one another. As you might know by now, ordinary income tax rates are on a marginal basis. What that means is if you generate a certain amount of ordinary income, even if it creeps into the next highest bracket, it doesn't mean all of your ordinary income is taxed at that bracket's number. You end up paying a blended rate of taxes depending on where your ordinary income falls on this chart. Same with capital gains. If you generate enough capital gains that you end up in multiple of these brackets, you don't pay all of it at one tax rate necessarily. You pay a blended rate between all of them. Now, since the 15% rate on long-term capital gains takes up a huge chunk of income spectrums, a lot of times it's really easier for people just to slap a 15% expected long-term capital gains rate on long-term capital gains. But in reality, if your long-term capital gains spans more than one of these brackets, you'll pay a blended rate on your long-term capital gains tax, somewhere between 20 and 0%. So using what we've learned thus far, let's walk through a quick example. Let's say Bob and Sue earn $179,200 in W-2 income this year, and they generate $100,000 of long-term capital gains. Well, their adjusted gross income is the combination of those two, which is $279,200. Then they take the standard deduction out of that to generate a total of $250,000. But the standard deduction comes out of their ordinary income first, and then capital gains goes on top. So their ordinary income went from $179,200 to $150,000, and then they have $100,000 of long-term capital gains added on top. So although it's $250,000 of taxable income, it's taxed in two different ways. So let's jump to the chart and take a look. So ordinary income is taxed first. So at the $150,000 of ordinary income mark, we're going to draw a line here, and that's where the top of their ordinary income tax bracket stops. Then they're going to pay a blended rate on everything underneath that. Then long-term capital gains gets added on top. And so that stacks on the right side of the graph all the way up in the 15% bracket. So in this example, their ordinary income taxes span 22 to 10%, so an effective rate somewhere between there, whereas their capital gains is entirely taxed at 15%. Now let's take the same example and say Bob and Sue, instead of earning $179,200, earn $79,200. Again, we take the standard deduction out of their ordinary income, so rather than $79,200, they actually only have about $50,000 of ordinary income, taxable income. And so let's draw our line there. We'll keep the same $100,000 of long-term capital gains that they generated. So $50,000 of taxable ordinary income lands them in the 12 and 10% bracket, so they're going to pay a blended rate somewhere in between there. And then long-term capital gains gets added on top. So in this example, a good chunk of that long-term capital gain is taxed at 0%, and another chunk is taxed at 15%. And ultimately, that makes a blended tax rate. Now, blended tax rate and effective tax rate aren't like technical terms the IRS comes up with. It's just an easy way to understand a portion of XYZ income is taxed at this level, and a portion of XYZ income is taxed at this level, and you add it together. Now, let's take the same example. Let's say they've got $50,000 of net ordinary income after taking the standard deduction, but they're boomers and they sold their uber appreciated home they bought in the middle of downtown Seattle or whatever, and after taking the home sale exclusion, they still generated another $700,000 of long-term capital gains. So using that same $50,000 of ordinary income line, they then have to add on top the $700,000 of long-term capital gains, and that pushes them all the way up into the highest bracket possible. But using what we've learned so far, that doesn't mean they're going to pay 20% on the $700,000 of generated long-term capital gains. They're going to pay a chunk at 0%, a big chunk at 15%, and then a small chunk at 20%, thus creating a blended long-term capital gains tax rate. You can see how it's really easy kind of shorthand just to use 15%, because odds are, unless you're in the uber wealthy division, and you'd know if you were, you're not really going to be paying 20% in long-term capital gains. But you'll probably pay somewhere in the ballpark of 0 to 15%, and then just being on the safe side, 15% is an easy round number to use. Okay, so hopefully that was helpful in breaking down how the various tax rates interplay with one another. Again, ordinary income is taxed first, minus the standard deduction or itemized, and then the long-term capital gains is added on top. So a couple things to watch out for when you're adding up these various income sources. Although you might have a relatively low ordinary income, if you generate a lot in taxable gains, that's going to increase your adjusted gross income, because adjusted gross income is the combination of both those sources of income, even if they're taxed at different rates. And based on what your adjusted gross income is, that's going to dictate a lot of different tax credits, provisions, extra taxes, etc. One of them being the eligibility to make certain retirement account contributions. So be mindful of what both of these income sources add up together to be. In addition, for my clients that are nearing or currently in retirement, your Social Security taxable amount, also known as your provisional income, which dictates how much you get to pay again on Social Security income taxes, that is including your adjusted gross income. So you need to add up all that together. If you generate a ton in long-term capital gains, don't be surprised if you end up paying more for your Social Security income. And specifically for my clients who are on Medicare or 2 years before filing for Medicare, Your modified adjusted gross income, which is basically your adjusted gross income plus a couple of things, is going to affect your IRMA, or income-related monthly adjustment amount. The more you make in retirement, or 2 years before 65, then you might be in jeopardy of paying more for Medicare than everybody else. And that's based on how much in total, adjusted gross income you generate. So a couple things to watch out for depending on, how you're structuring your tax bracket management in retirement. Hopefully this was helpful. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.